Welcome back. The NSE has just closed. Safaricom has traded 12.75 million shares. That's a huge amount of stock, and certainly someone is seeing a lot of excitement in this particular stock. We've also had incidences of them actually starting to set up 5G. So it could be that we have a new set of investors who are interested in this particular counter. A lot of volume going through this week and last week. The second traded was KCB. 2.4 million shares were traded. Equity, 1.6 million shares were traded. Kengen was a surprise mover over the day with 2.26 million shares traded. That's what we have from the NSE. We go back to our conversation with regards to the macroeconomic outlook for Kenya. David Gitar is with us in studio. David, just before we took a break, we had discussed the outlook on interest rates, on exchange rate, on inflation, and as well as GDP. How would you summarize the 2020 macroeconomic outlook, and what ranking would you give some of the factors that you'd use to summarize this?
So for the 2020, based on those indicators that we mentioned, our outlook was neutral. The first one was government borrowing, which is negative, mainly because of the issue on the foreign debt side, the repayments, as well as the structure of the debt. For the domestic debt, it was mainly because of we're expecting the government to face a lot of pressure right now this year because of the repeal of the interest rate cap, which effectively means that they will now be competing with the private sector in terms of the finances. The next one was on exchange rate, whereby we are neutral, mainly because with a bias to 2.4% depreciation.
Okay.
Mainly because of, if you look at most of the factors that have been supporting the currency in the previous years, things such as the diaspora remittances, which for the past 2 years they were mainly high because of that tax window, the 10% tax window. But since the close of that, we've seen relatively slower diaspora remittances growth. Also, things such as forex reserves, we've seen like last year they were in an all high, mainly because of debt receipts. But the 2.1 billion euro bond receipts. But this year we don't expect anything on that front. We are mainly faced with repayments.
All right.
For interest rates, we were neutral, mainly because of, in as much as we foresee that rate cut by maybe 50 BPS, there are still that expectations of pressure on the government side, and we might see an upward readjustments on the yield curve, so that the government can incentivize people to participate in the primary auctions. For inflation, we are positive, and we don't expect any inflationary pressure this year due to maybe a reduction of food prices. GDP, we were neutral, mainly because of, in as much as we have that expectations of 5.7%, unlike the previous years where we were seeing we were foreseeing economic growth to be higher than the average. The average for the past 5 years was at around 5.7%, and we foresee some pressures, mainly in terms of the fiscal space.
Okay.
The other one was investor sentiment, where we are still positive, just like last year.
Is it for both asset classes, equities and fixed income?
For investor sentiments, the main thing that we were looking at was equities, as well as maybe the investor perception in the outside markets. Now things such as now the Eurobond yields, how we expect them to perform.
Do you think they're going to get lower? We've seen a bit of weakness over the last 1 week.
Okay, like last year, we saw that what was supporting the yields last year mainly was that perception in terms of maybe the credit ratings. We saw Moody's as well as Fitch rating maintaining the credit rating of the country, so there wasn't as much pressure. This year we still expect the same thing. We don't foresee a lot of pressure in terms of maybe the credit ratings, etc. For the equities markets, last year we saw positive inflows as opposed to maybe, let's say, 2018. And this year we still expect the same. And we've seen a lot of interest even these past few days in terms of inflows.
Actually coming in.
Mainly also supported by things such as the banking stocks.
All right.
For security, I think we are still positive on that. Mainly the political side, we haven't been seeing a lot of pressures opposed to the previous years. So based on that, on those indicators, we are neutral in macroeconomic conditions this year.
All right. And then I think maybe my final question, when you're talking to investors, are you telling them to put money in equities this year or in fixed income? Because it looks government needs money. There is a possibility of the yield curve raising from where it currently is. So where are you telling people to put their money?
Right now, we are more biased to the equities side.
Okay.
For fixed income, the advice that we are giving clients right now, it's if you are to invest in fixed income, mainly should focus in the short-term papers right now to avoid that duration risk.
All right.
Because if there is maybe that possibility of an upward readjustments, if you are investing in the fixed income market for trading purposes and not holding to maturity, for sure, if you go long term, it will affect you in terms of the pricing.
Okay, fantastic. That is a very good evaluation of the economy. Thank you so much, David, for your time. So there you have it. His sentiment is mostly neutral, but then investor sentiment is certainly positive. He's telling his investors to put their money in equities. Have you started your investment strategy for this year? If not, what are you waiting for? Thank you for joining us today. See you tomorrow, same time. Good afternoon.